Our next guest has brought along two stock picks to fight the market's big uncertainties, the global energy crisis and the normalisation of monetary policy. Joining us now is Fenton from Sage Capital live in the studio. Sean, great to have you in this morning.
Thank you.
Set the scene for us when it comes to these uncertainties at the moment.
Yeah, there's certainly plenty of them going on. So you've got a situation we probably haven't had for several decades where the Fed's facing an inflation outbreak. It's all around the world, so it's not just the US, the UK, Australia's a little bit slow but coming through as well. But they're facing the prospect of having to tighten into a lot of geopolitical uncertainty. So Russia invading the Ukraine, commodity prices going everywhere. For the first time in a long time there's real material inflation. It's feeding back into wages, particularly in the US and parts of Europe. So we've got the prospect of actually having to have tight policy and central banks maybe deliberately pushing us into recession for the first time since the 90s. 2008 was an accident.
Yeah, if it's not the central banks, it might be the crude price. Energy prices are just skyrocketing around the world and incredibly volatile. The crude oil price, I was saying this earlier on the program, Brent crude at one stage was $40 from the highest hit only last week. Obviously, it's still very elevated at the moment. Given how volatile it is, given how uncertain it is, how do you go make an astute investment in that space at the moment?
I think one of the interesting things about that volatility in crude is a lot of the Australian energy stocks haven't been that volatile. So if you look at the forward curve, Brent shot up, but it's in steep backwardation. So the forward price has just been creeping up slowly, and some of our energy stocks have been doing the same. So we quite like Santos, which is pretty much still trading the same level as it was a year ago when Brent was $60 a barrel. So we do see that volatility staying with us going forward, whether you get a resolution in Ukraine with Russia or not. I think sanctions are there to stay. There's going to be some disruption, but even without that, we like the energy outlook in the sense that whilst there's this transition to electric vehicles, electrification, renewables, there's still that intermediate role to play for gas, in particular in LNG, and I don't think that's going away in a hurry. And I think the volatility has really re-emphasised that. So Santos, great free cash flow, acquired Oil Search for pretty much nil premium scrip merger last year, and it's got some real opportunities there to sell down or sell out of Alaska, which Oil Search was developing, sell down in PNG, look to expand another train there, sell down Dorado, very oil-rich discovery that they can develop, and it's going to have a very strong balance sheet, oodles of cash, so you've got great free cash flow, probably some buybacks coming in there as well and help it re-rate.
What do you put down to that valuation gap we're seeing at the moment? Is it an ESG story at the moment that keeps that the capital value from rising relative to where we've got the futures curve?
I think it's definitely been an aspect of ESG where a lot of investment firms have reduced their holdings of anything that's emitting CO2. So that's played in there. I think the interesting thing around Russia and the Ukraine is it's really re-emphasised the S part of ESG and some of the broader social issues, and particularly around democracies and autocracies and energy security and those sort of aspects. So there's a bit of a rebalancing towards an acknowledgement of the need to have energy security there in the short term alongside the broader environmental targets. So I don't think that's going to get any worse going forward, and maybe that discount could actually come back in a bit.
So that's the commodities play. Let's talk the policy normalisation play when it comes to the tightening cycle. Where is it?
So generally, when central banks are tightening, it's generally bad for everything. So you want to be in cash, and particularly these days where bonds have been taken down so far in terms of central banks expanding balance sheets, they're all correlated. So it's really hard to find places to hide. So one stock we really like in that environment is Computershare. It's generally not that exciting in terms of a business and growth, registry services, shareholder communication, but it's very stable. It's got some good underlying organic growth, but it does hold big client balances that earn interest, and they've gone to zero in recent years, and it's been really a headwind for the stock for quite a while. They bought Wells Fargo's corporate trust business last year, which has really expanded their US dollar deposits on hand, and as cash rates go up, they've got enormous leverage in terms of their earnings. And as we saw yesterday with the Fed lifting its dot plots further out in 23, and we actually see that just continuing to move up because those inflation wage feedbacks are so strong. Computershare is a rare company that actually benefits from that and has some upside, so I think it's a great hedge in the portfolio.
Are there any other areas, sectors, stocks out there that could go and benefit from that rising rate environment? You mentioned the Fed dot plots imply that they're going to go and take policy to 2.8% for the Fed's fund rate.
Yeah, you definitely want companies with pricing power and a degree of inflation hedge there. So we quite like the supermarkets as well. So generally food inflation, that's certainly coming through with soft commodity prices, wheat moving up. They tend to get a broad lift of gross margin, a lot of very high revenue turnover, fixed cost bases, so that the dollar value lifting helps their gross margins. Plus, they're very defensive in an economic downturn, so pretty non-discretionary spending. So that's a good combination. Metcash is a stock we really like there because it's going through a bit of a transition, trading only on like 15, 16 times, great yield. Other stocks with top line in terms of hedges. Commodities are generally pretty good at that. They're what's driving inflation. You just got to be careful if the central banks get really aggressive, they can flip the other way in a recession. They can be genuinely cyclical. So we see this as a strong commodity cycle, not like a super cycle where China's just driving iron ore consumption. There comes a time where you've got to be careful of resources, so you need to watch the timing there.
Yeah, what else are you completely avoiding in this environment?
I think unprofitable tech, it's just hard to see that making a comeback because you've got a broad lift in bond yields and tightening in liquidity. Markets are under pressure, so any company that requires funding to continue its growth going forward has been trading on high multiples and concepts. That's unlikely to change. It looks like it's in a world of pain, so avoid high multiple stocks, particularly those that are unprofitable.